Another crazy day, 7% move in SPY. Just want to go through a few things. So we gapped up super high today, um, and it basically sold off the entire day. From the peak, from the intraday high to the intraday low is about 7%, 6.8%. Q's closed down almost 2%. S&P closed down 1.5% on the day. Dollar closed down 0.5%. Um, and I think this is interesting. This is worth pointing out. So I had mentioned the capital rotation story. I think that that is still uh, in play. This is the 10-year here. This is the 30-year here on the far right, and then the dollar to the left. There are these two periods of time where the dollar was selling off and yields were rising. So that's the yellow box. And then in the green box was this kind of other period of time I noticed that the dollar was selling off and yields were rising. So what that means, yields are inverse to the value of the bond. So when yields are going up, bonds are going down. The value of the bond is going down. So selling bonds, getting dollars for those bonds, but then selling those dollars. So when you see capital rotation, it's bonds down, equities down, currency down, and that's what we were seeing. Not the entire day, but you know, prolong a couple, 1 hour, 2 hour periods during the day where we were starting to see that again. And the yields were just absolutely insane today. Was the main thing I wanted to talk about. So the move index, we had mentioned this before. This measures the vol. It's basically the VIX for the U.S. Treasury market. After we recorded the video yesterday, the data came in and it closed up here. It printed, I think, 137. It looks like it after today, it's even higher. It's now 139. Anything over 130 is pretty significant dysfunction in the Treasury market. Here's a weekly. So you can see that the last time the move index was this high was late 23. And I'll remind people that the period here where it was up in these elevated ranges, this was like 2022 was one of the worst bond markets in US history. So you can't, it's not the kind of thing where you can look and go, oh, well, the move index, it's been here before. It was here, 1, 2, 3, 4. Yeah, but that was like the worst bond bear market in US history in like 100 years or something. Also want to cover the VIX. The VIX had its highest daily close since COVID. So going all the way back to March 30th of 2020, highest daily close. Closed at 52, closed over 50. I consider anything over 30 to be pretty serious volatility. Certainly anything over 40, anything over 50, and I start to get slightly worried. I would also point out implied correlations moved higher today. There was some volatility intraday, but I think we're starting to see a deleveraging. We mentioned this on, I think it was Sunday for the weekly recap, that we thought that a good amount of the cross asset action we were seeing was just kind of broad-based deleveraging. The implied correlations moving higher kind of reinforced that. Gold was down again. Bitcoin was down on the day. Everything's pretty much selling off. I would point out that, again, we were talking about this on the Sunday weekly recap, but the safe havens are the Swiss franc and the yen. So this is dollar Swiss franc. So, when the chart is going down, that's dollar weakness or Swiss franc strength. So lower is a stronger Swiss franc. And this is one of the safest currencies kind of in the world. And yeah, you can see that it's actually one of the few currencies that has performed well against the dollar. It's one of the few currencies that has actually gotten stronger versus the dollar. You can see it's broadly range bound, going back to was that 2008. So, but that being said, it still has strengthened ever so slightly versus the dollar. So it's always been a strong currency. Today we just saw even further strength. You can see over the past 2 weeks, it's had a pretty decent move. And then the yen. This is a weekly chart. Um, and again, US dollar, yen. So lower on the chart means yen strength, dollar weakness. We'll go to the daily. This just opened, but today here you can see the yen strengthened, and so yeah, the dollar was down though on the day. It had this pretty good pop yesterday, but then ended up closing lower. And like we said, bonds were selling off, yields were higher, and they were a lot higher. So let's go to. We had an auction today. I'll point that out. 3-year auction, and it had the third biggest tail in history, from what I can tell. And the tail on an auction, maybe we'll do a video on it one time, but um, auctions have are somewhat complicated. There's a few data points that come out with every auction. One of those data points is called the tail, and basically that's the difference between the actual market demand. It's a Dutch auction, so when the treasury bonds are auctioned, they basically go through. The, People put in bids, and you have and you the final yield of the bond, the final yield of the auction is basically, whenever the demand is or whenever the supply gets eaten up. So if there's low supply at, say, 3.7, there's some bids at 3.8, but still not enough to take up the entire bond supply, and there's a bid up here at, say, 4. Well, the when issued yield, the actual final, yield that gets issued to everyone is 4, because that's what it took to eat up the supply, to eat up all the bids, to take up all the supply that's being auctioned off. So it would probably be helpful to have a graphic. I know it probably doesn't make a ton of sense, but yeah, the difference between the yield um, at the time of the auction versus what it basically takes to get through the entire supply. That difference is called the tail. And we saw on the 3-year, we saw the third largest tail on record. So yeah, yields moved higher, much higher today. We said yesterday in the emergency update kind of thing, I didn't think I'd have to do another one, but this move in rates is kind of scary at this point. So again, yield is inverse to the value of the bond. So when yields are moving higher, the other way you can think of it is this is what's happening to the value of the bond. So if you're thinking of it in normal terms, as a normal person maybe holding a stock, this thing is these long duration bonds are just absolutely dumping. And of course, like we mentioned, the dollar is also down. So, that starts to indicate capital rotation. And the fact that yields are moving this sharply higher, this is the 20-year yield. The fact that yields are moving this sharply higher, given the fact that we are in one of the biggest growth scares, negative growth shocks to the global economy since COVID, is incredible. Bond yield should be down. People should be buying bonds. At the very, very least, yield should be maybe 2 or 3 basis points up or down, maybe flat, relatively speaking, flat on the day, given the fact that we have the highest tariffs in 100 years, the largest negative growth shock to the global economy since COVID. Maybe yields are up 2 or 3 basis points, maybe 4 basis points, but they should not be doing this. Uh, Today we saw this is the 20-year made a 14 basis point move higher, and the 30-year, this is the 30-year, made a 13 basis point move higher, and the 10-year made a 9 basis point move higher. And it looks honestly like long-term rates are breaking out to the upside. So I try not to apply TA technical analysis to everything, but it's just the way I see things. And rates have been in a pretty decent downtrend here since January, but they look like they want to break out to the upside. Like the fact that I'm saying that, given what's going on kind of in a macro sense, is just insane that we have rates breaking out to the upside. It's just there's only two conclusions that I can come to. One, foreigners are selling bonds. I'll remind people, the net international investment position. So what foreigners own of US assets versus what we own of their assets, that delta, that difference. Our net international investment position is negative 80% of GDP, negative 80. So call it about 20 trillion. Um, on a net basis, that foreigners own of our assets. It's not all treasury bonds. Of course, there's equities, corporate bonds, other securities in there. I think that the foreign holdings on a net basis for just U.S. Treasuries is, I think, 9 trillion. So that's a lot of U.S. Treasuries that can be sold. And think to offset that, right? If rates were to come down, or what would be needed to get rates down, is 9 trillion of buying pressure. Where is 9 trillion of buying pressure going to come from? I'm not saying that every single treasury held by every single foreigner will get sold, or is getting sold. Of course, that's not true. But just to give a sense of scale, this is what the U.S. has gotten itself into. It's gotten itself into this predicament where can't really start to rein in foreigners because they own so much of your government debt. They own so much of your equity, corporate bonds, real estate, everything. You have sold out your country and its assets and its securities to foreigners. And so you are kind of at the whim of those foreigners. And if they decide they want to rotate out, and they don't want to be in dollar denominated assets anymore, you'll see stuff like this where bonds get sold super hard, rates move sharply higher. And remember that given the fact that we have 36 trillion in total gross debt, and 7 to 9 trillion to refinance this year, every 5, 10, 15 basis points matters, given the interest expense for the country. So rates start moving higher, interest expense moves higher. What happens when interest expense moves higher? Well, that blows out the deficit. So Treasury issuance must increase to cover that increase in the deficit. Treasury issuance increases, say constant demand. Well, increased supply and constant demand, value down, yield up. So rates move even higher, causing interest expense to move even higher. You can see how this becomes kind of the debt spiral. And this is also what you see in emerging markets that are heavily indebted. You see during a fiscal crisis, which can include just a kind of garden variety slowdown, recession, you see rates actually move higher. And I've been saying this for about a year, that in the next growth scare for the US, we could see rates move higher. It's a little too early to say that I 100% nailed that call, but I think that the past 2 days, the fact that yields have moved this much, given the context of what's going on, is indicative that I think I'm onto something, and we could see more of an emerging market phenomenon where rates move higher in a recession, which just makes everything that much worse, right? Because in a recession, kind of definitionally, your revenue, if you're the government, your tax receipts from stocks and payroll tax, right? Your revenue is falling. People are losing their job. They're selling, stock market is down. So they're not sitting on as much capital gains. So capital gains tax revenue is down. People are losing their jobs, less income tax revenue. Revenue falls during a recession for the government. And due to the automatic stabilizers, their expenses go up in a recession. So on average, this is why recessions increase the deficit by about 6 to 8% of GDP. And we're starting from a 7% of GDP deficit. If we do truly enter a recession, we're talking about a deficit as a share of GDP of like 15%. And these things are nonlinear and they're also vicious cycles. It all kind of feeds on itself. And so, 15% very quickly becomes 20%, which very quickly becomes 30. And very quickly we could find ourselves in a really, really, really bad situation. Um, so I think the move in rates is like really the story here. Sure, S&P sold off really hard. I mean a 6% intraday range on the S&P 500 is pretty incredible. Don't get me wrong, that this is wild for sure. But really the scary thing is the move in rates. And I would just say, just kind of my thoughts in terms of a bottom. This is the daily chart for the S&P 500. Yes, it's oversold, but man, this thing looks super bad. Like this is an ugly chart. This daily candle, sure, it bounced a little bit towards into close, but in general, this chart looks horrible. And if you look at like the weekly, yeah, this thing just looks horrible. And there's a gap down here in the mid 440s. So yeah, I don't know. Equities just still continue to look pretty bad. I mentioned gold was starting to look good for a long, but not bad. Gold could fall further if I'm right, and there is kind of a broader deleveraging going on. Gold could fall further, but it's for sure the strongest looking chart. Bitcoin doesn't really look that great, in my opinion, um, on the longer term time frames. It could bounce here. This is, we're right around the 24, that kind of 72, 73, and it bounced right there. And so a lot of times, just basic kind of TA lesson, this is support resistance flip. So this was resistance here, the 72 that we just could not break for the life of us. That 72 is resistance. We broke through it. And a lot of times what will happen is the market will come back and test that price. And so a lot of times you see what used to be resistance become support. And so we could see something where it bounces here and moves higher. This was pretty well established resistance here, maybe a little lower 72, like mid 72 probably. But the difference between mid 72 and 76, if you're looking for a long, is not much. You could do a starter position here and then add to it if we go lower. Honestly, just kind of in a 30,000 foot view, things look pretty bad. I mean, the move index, up at 140, correlations that are so high, spreads that look like they want to blow out even further. Oil, this is crude. Oil broke 60, and like we mentioned in the weekly recap, it just sliced through it like a knife through butter. I mean, this move in oil is pretty incredible. Now, of course, it's starting to get oversold. There could be a short-term bounce, but it moved from 71 to 57 in 5-6 days. 20% move in oil in basically a week. That's something to, that is definitely sending a signal. The VIX over 50 is sending a signal. The fact that the dollar is down, yields are up, and equities are down is sending a signal. The fact that the safe haven trade appears to be the Swiss franc and the yen of all currencies is sending a signal. And so we think that these are all important things to watch. Let's see if there's anything else. The rate story is really, we'll check LQD, HYG. Yeah, spreads came in a bit. I will point out though, the B of A high yield option adjusted spread, it looks like it's blowing out. I'm not sure why LQD over HYG would be sending such a different signal here. We'll do this so it's easier to see why this spread came in quite a bit. versus the B of A high yield option adjusted spread. So it could just be a methodology for the B of A spread, but like we've been saying, we think the spreads saw their tights back here. That's why that arrow is there, and will not go tighter than 2.6 and are probably headed much higher. And again, the 10-year, the move that we are seeing in long-term rates is just crazy. People are saying, "Oh, well, it's just back to where it was in what is that? March 28th. They're just back to where we were March 28th." Yeah, but March 28th was before we announced the largest tariffs in 100 years. That was before the largest negative growth shock to the global economy that we've seen since COVID. That was before a lot of things. A lot of things have changed in a negative growth sense um, since then. And the fact that yields are actually higher than where they were when tariffs were announced is just incredible. Like, there is something going on. We're not sure if it's partly a basis trade unwind. This is where hedge funds were getting super levered. We've mentioned it before. We're not sure if it's a basis trade unwind, partly, or if it's foreigner selling. But there's really no good reason why rates should be moving higher at all, let alone 30 basis points like we saw yesterday, and again 10 basis points, another 10 basis points today. Like, rates look like I said, long-term rates look like they are about to break out, which would be insane given kind of the macro conditions that we have. Um, it's the mortgage spread. We'll look at the 10-year, 2-year spread. So this is the 10-year yield minus the 2-year yield. This is the common. You can do many different Treasury spreads. Some people do like 3-month, 10-year. There's a number of different spreads you can pick, but the 210 is a common one. And this shows you the steepness of the curve. And so what this is indicating, the curve has been steepening since kind of bottom in July 23. But this move higher today, we didn't mention it. We'll show it briefly. This is the 2-year on the daily. And you can see the 2-year actually got bid. Yield came down, so bond value up. So the 2-year got a bit of a bid. Meanwhile, we've been over it, but we'll show it again. The 30-year sold off hard, rates up sharply. So what that results with is a steepening of the yield curve. And this indicates, basically the premium that investors are requiring for long-term Treasury, for duration for U.S. Treasuries. And this is, also a fiscal story. We think that that's some part of the move higher in rates, right? Like, if some nerd like me understands kind of, very basic concept that in a recession, in a growth scare, an economic contraction, deficit widens. We've been through the mechanics of it. If someone like me can understand it, the bond market surely understands it. And so, they recognize the risk for financial repression, for monetization of the debt, for yield curve control. Pick your adjective, QE. Higher inflation, financial repression, whichever term you want to use, they recognize that risk and are now demanding a higher premium, higher interest rate to take that duration risk. Because again, think of it this way, if you are buying a 3-month Treasury, you're not really that concerned with inflation. You're only locking yourself into 3 months. If you're buying a 3-year Treasury, okay, now you got to consider, well, not what inflation is today and next week, but also next year and the year after that and the year after that. So, and then you start getting into real long-term duration, like 10-year, 20-year, 30-year. That is a whole different calculation. You are locking, as a bond investor, you are locking yourself into 10 years, 20 years, 30 years. And so the risk, hopefully that makes sense, that the risk for inflation, your risk appetite goes down as the duration extends, as the duration goes out. your willingness, your the risk of inflation over 30 years is a lot different than the risk of inflation over 3 months. And so that premium it can be seen in the steepness of the yield curve. And what we saw today was the yield curve steepened dramatically. So, clearly part of it is probably fiscal concerns. This is the term premium. Yeah, so term premium has come in, but we expect this to be higher. Just generally speaking, long term on a long term basis, we think term premium is will be higher than it has been historically. You can see it's been in this kind of general uptrend since 2020, um, but it's been trading in a range. But we expect it to move higher as the fiscal concerns become more acute. Um, yeah, I think we think the rates are the thing to keep an eye on. This is not what you want to see when you're given the macro context of what is going on and just the negative growth implications. Rates should be moving down. People should be buying bonds, not selling them. And the fact that the dollar is down along with it and equities are down, there is some significant degree of capital rotation out of dollar denominated assets. And that trade is very, very large, tens of trillions of dollars that could leave the stock market or the bond market. Um, the implications of a US dollar carry trade unwind are immense. And so, yeah, we were left kind of speechless today, given the insane volatility we're seeing. I mean, the fact that S&P is moving 6% intraday is pretty insane. The fact that VIX is closing above 50, oil, had a 20% move in the past week. The yen of all currencies is acting as a safe haven, not the dollar. Yeah, we just there's a lot going on. Trying to make sense of it. Hopefully, this is like somewhat helpful. Once the days start being a little less crazy, hopefully we don't have to do like daily updates. Um, this is the break even, the eighth. Okay, so this is the break even, and it does look like they moved that this is the 10-year break even swap, inflation swap, and it did move. The 10-year moved up 3 basis points, and the 5-year moved up 4 basis points. So okay, so if we go to the 10-year, I think I said it was a 9 basis point move. Okay, so the 10-year yield moved up by 9 basis points. The 10-year inflation swap, this is basically a way to get an indication what the market's expecting for inflation. The 10-year inflation swap moved up 3 basis points. So you could attribute 3 basis points of this move to inflation concerns. But that leaves 6 basis points. And if you look since yesterday, it's much more than 6 basis points. So this is the 10-year minus the 10-year inflation swap. So this is kind of a quick way to find the real rate. This is like the after inflation rate. And you can see that it certainly moved higher. This is a significant move higher, but yeah, what it's due to, whether it's due to a basis trade unwind, foreign selling, we're not quite sure, and we don't think anyone is 100% sure what's going on. We're just trying to make the best sense of it. But yeah, hopefully that was helpful, and hopefully markets are a bit calmer tomorrow.